Hey, personal finance gang. Let's continue our mutual fund adventure by starting off with a term you've already seen. So we talked about this when we talked about the size of a company's stock, market cap or market capitalization. This is just the total dollar value of a company's stock. And right now, that's just price per share times the number of shares outstanding. Right now we have two companies that I know of, I think that's all, that have market capitalizations of over $1 trillion. So I think that's both Apple and Microsoft are both worth over $1 trillion. So if you take their price per share times the number of shares outstanding, you get more than $1 trillion. So we're looking at this again now with mutual funds, because one way we categorize funds, or one way we can categorize funds, is by the sizes of the companies that the fund buys. So remember, small company stocks are a little bit riskier, or maybe a good bit riskier than large company stocks, but they've had historically higher returns. So if you wanted a portfolio of small company stocks, you could pick a small cap fund. If you wanted more large company stocks, you could pick a large cap fund, so a fund that invests in large companies, or you could be in between. Or you could get a fund that invests in a combination of all of these. But sometimes we have funds where if you want small companies, large companies, mid-sized companies, you can pick based on size. And I was going to see, yes, so here's Vanguard. I'm going to pull over the Vanguard funds and U.S. stock funds. So here we have, this is Vanguard, U.S. stock funds. Right there, they have large cap funds. Go down a little ways, mid-cap funds. So these are medium-sized companies. Go down, small cap funds. So that's just one way to classify stocks and to pick them. And we know, again, risk-wise, the smaller the company, everything else equal in general, the riskier large cap companies had to grow up and get through this phase to become large companies, so they tend to be less risky on average. Another way to categorize stocks, and also therefore mutual funds, is by whether they're value or growth stocks in the fund. So value companies are our lower priced relative to certain measures. So can you get a bargain based on the price earnings ratio? Remember, we saw that before. That's one way to classify a stock as a value stock. Growth stocks tend to be, they're stocks that have been growing earnings and share price at an above average rate, and you tend to have to pay more for them because, they're doing so well. So we'll see some funds that are classified as value, some classified as growth. We pull our Vanguard stuff back over here, and where am I? Okay, large cap shares, and right here I've got there's growth and income, growth index. Keep scrolling down. U.S. growth, U.S. value. So here they have you want large company stocks that are growing. You want large company stocks that are more value or bargain priced. And at different points in time, different funds have done better. And lately, growth has been, for the last many years, growth's been kicking, the last 10 years or so, growth's been kind of winning the battle. Over the last 80 years, value has tended to have a little bit of an edge. But if you look at the 10-year returns here, so growth 12.56, value only about 7. The last year, value is supposed to hold up better in a downturn. Value's down about 26%. That's horrible. Growth only down about 6%. I kind of abandoned my love of value because, I mean, you're supposed to be patient and wait for them to come back because anyway, but I lost patience, which isn't what we're supposed to do in finance. But anyway, so that's again another way to classify funds: value versus growth. And value may come back into favor down the road, but it sure hasn't been in favor for a while. Now, another way, so you may see funds where they say, hey, this is a large cap or a small cap and we're value, but the style box, the Morningstar style box, this is a place that looks at funds and stocks and whatever, looks at market cap and classifies the portfolio based on actual holdings. So the classification in the style box may be different than what the fund says its actual goal is. So let me just pull up, well, here's the Capital Value Fund at Vanguard. And so here's some of the info you could see on a typical fund. So a summary, this aggressive value fund takes an opportunistic approach to companies of all sizes. So they go to all sizes. But anyway, so that tells kind of what they're doing. There's a little bit of historical performance. Here's what $10,000 would have done over time since 2010. Didn't do very great. Sorry, I'm kind of down on value lately. The biggest holdings right now, the top 10 stocks they're holding in this fund make up 25% of the total dollar value of the fund. So they've got money in T-Mobile, Comcast, Philip Morris, Raymond James. Anyway, so that's a financial company. This is obviously tobacco, CVS. But anyway, so that's just a little bit of the info you can get real quick on a fund. But let's see their style boxes, which is what I headed this way for. They're classified as a mid-cap value. So the style box up here is value, growth, or a blend. Small cap, medium cap, mid cap, or large cap. The Vanguard Capital Value Fund, based on their typical holding, is a mid cap value. So let's just check and make sure they're actually consistent with their goals. And they did say they buy all sizes and they shoot for value, and that's what they have. So that's a style box, and you can look those up for most, probably find those for most funds. Not everybody necessarily will, all the funds will show that, but if you went to Morningstar, you can see that. Now, we want to categorize, we have more ways to categorize funds, and the object of categorizing funds is so that you can find a fund that meets your investment goals without having to read all the details here. So aggressive growth is one way to categorize them. And this just is a fund that focuses on capital gains and is willing to take more risk. So let's say you're saving for your retirement 45 years off, and you're willing to, you don't have much money now, so you're willing to take some risk with that because, well, heck, you're starting out small, you don't have a lot to lose, you have plenty to gain. So maybe you think you're willing to take on the higher risk level. If it pays off, good. If not, well, you just have to keep saving a little bit more down the road, but you've got plenty of time to catch up. So that's one category there. Focused on getting capital gains, increases in stock price, willing to take more risk. Equity income, equity, code name for stock. Equity means you're part owner, so you're buying stock. And income, if you recall, what is the income from stock? That's the regular cash flow that a whole lot of companies pay. Those are dividends. So an equity income fund, the goal there, if you want income, you're looking for safe, predictable. So you're looking for safer stocks that pay relatively high dividend yields. So that's what equity income is for. And for you saving for retirement, this isn't probably what you want right now because you don't need regular cash flow if you're trying to grow your portfolio for retirement. Growth and income would be a mix. So you don't, even if you aren't taking the income right now, you can reinvest this in the fund. So it's a mix of, hey, getting the price to go up and getting some more certain dividends. Anyway, so it's a little bit lower risk level than that aggressive growth and a higher risk level than the equity income. A balanced fund usually has a combination of stocks and bonds. So, this would be stocks we know are riskier than bonds, but have higher return potential. So this might be something for you if you want some of the security, some of the protection from downside risk that bonds have. Bonds can still lose and can still lose a lot. We've seen that even recently, but generally they would go down less percentage-wise than stock. Asset allocation fund, and these are cousins here, might diversify stocks, bonds, and money market or cash type investments. So your fund manager in both these categories will have some, or maybe moving in and out of stocks or bonds. It's more true with this. If they think now's a good time to be in stocks, they move more money towards stock and out of cash and bonds. If they're worried about the market declining, they might move more money to bonds and money market securities. We'll see some examples of these later. Now, a very popular and one of my favorite categories of funds that goes across all these boundaries, or can cross all these boundaries, would be an index fund. So we have actively managed funds where a fund manager is trying to pick winners and beat the market. So with an actively managed fund, one thing finance and professionals do, spend time and resources and energy and money to pick winners. Well, that's going to cost you money to get that. And an index fund says, forget that. It's really hard to beat the market, which in fact it is. So these funds just say, we're going to try to match the S&P 500 index fund, for example, or we're going to try to match a small cap index. We're not going to try to beat this category. We're just going to match it. So they may do so by buying all the stocks in that index or a sample of the stocks in the index, but their goal is just to try to match it. And by doing this, what they can do is have lower expenses, and we'll talk about expenses later on, and this allows them to cut costs for you. And I've got here the little deal here. Index funds typically have much lower fees than actively managed funds, and the fees are pretty much guaranteed, the returns aren't. So on average, index funds have tended to outperform actively managed funds because the actively managed funds have to not only beat the index, but they have to beat it by enough to cover their fees to make it worth your while. And on average, they have not tended to do that. But the problem is, if you ask an investor, do you want to get an average return or do you want an above average return? Well, nobody wants to be average, but so people go with the funds that are, hey, promising that we're going to beat the average. But again, they don't always deliver because they have to deliver and cover their costs. All right, so that was index funds, a popular category. I've mentioned before already the S&P 500 index fund. So you go to Vanguard and you buy a mutual fund, and here it is. It's got the 500 stocks that make up the S&P 500 index there. So 500 of the largest companies in there. Minimum of $3,000, charges a very, very low expense ratio. We'll talk more about that later on. All right, another thing you could do, let's say you decide right now you want to be in technology, but you don't want to have to worry about picking the best technology stocks. Or right now you think, with the virus going on, you want to be in biotech, or what do you think's good? I don't know. So you pick another category. You want to be in telehealth, and I don't know if there's a sector fund for that, but you want to be in a particular sector of the market, but you don't want to have to pick the winners. You can just pick a fund that either there are funds that try to pick winners in those categories, and there are funds that just try to match the average stock in those categories. So one fund family that has a lot of sector funds is Fidelity. I'll show you the problem with some of these though. So there's Fidelity has a software and IT fund. They've got a technology fund. They've got a IT services. They've got a medical fund. They've got a healthcare. They've got select healthcare. After services there. Computers portfolio, retailing portfolio, wireless portfolio, utilities, and on and on. So they've got 45 of these different sector funds. So you don't have to pick winners. You can have your fund manager try to pick them for you. The problem with some of these funds here that I have is you look over at the expense ratios. So that S&P 500 index fund from Vanguard is charging you 0.04%, pretty darn close to zero. Vanguard's a non-profit as well, so they have an incentive, another incentive, or you don't have to worry about taxes to keep costs low. But look at these, 0.72%, 0.78%, 1%. So these are charging you almost 0.75% or so, maybe on average there, to manage these funds for you. So they have to outperform whatever it is their benchmark by 0.75% to break even, or you would have been better off buying an index fund in these sectors. So kind of high, relatively high expense ratios for some of these. But again, you want to be in IT, you don't want to pick. You can just pick IT and you're good to go. Socially responsible funds, another category of funds. So if you say, hey, I don't like tobacco, I don't like firearms, different, you don't like companies that are bad for the rainforest, you can find a socially responsible fund that invests according to certain guidelines. You need to see what their guidelines are and if they make sense for you. There's a whole category of socially responsible funds. Now, another category of investing, we tend to think of, hey, the U.S. only, but it's a good idea to have exposure in your portfolio outside the U.S. There are times when the U.S. is doing poorly and other countries are doing great. Right now with the coronavirus, it's kind of bad all over, but other countries may rebound from this quicker than we do, and so their stocks in those countries may go up faster than we do. But a couple categories, if you want investments outside the U.S., stock investments outside the U.S., a global fund, there's a difference here. You'll hear of a global and an international fund. Well, heck, what's the difference? A global fund may have money in the U.S. and outside the U.S. One thing I don't like with them is they may be moving in and out of the U.S. trying to pick which area is the best or which countries are the best. But if you want money guaranteed outside the U.S., you would probably be better off with an international fund. So I'd like to know, hey, if I put 20% of my money in an international fund, I'll have 20% of my funds invested outside the U.S. With a global fund, they may be moving those weights around, and you'd have to pay attention to what they're doing to know how much of your money is truly outside the U.S. But if you could just wanted to put it in money and let somebody else try to pick which countries are the winners, a global fund might be the way to go. So what about tax consequences? So I think I mentioned this before, but if you buy and hold a mutual fund, you're not selling, you're going, hey, no tax consequences. We'll back up. If you buy and hold a single stock and the stock doesn't pay dividends, you could buy and hold that stock for 30 years and never owe any taxes. You would not owe taxes, assuming it didn't pay dividends, until you sold the stock, and then you'd pay your capital gains tax after having delayed all this stuff for 30 years. That's not exactly the way a mutual fund works. You buy and hold that mutual fund. Remember, the fund itself could be buying and selling shares of stock, and most likely is, and so you would owe your share of any capital gains or losses. Likewise, if the fund is getting paid dividends, they would pass these through to you. You'd have dividends and capital gains distributions, and you have to report and pay taxes on those distributions at the end of the year. So even if you're not buying or selling, you still could have tax consequences from owning a fund. So there are some funds that are managed to try to minimize taxes. Index funds are kind of naturally tax managed, because with an actively managed fund managers buying and selling, if they sell quicker than a year, that's a short-term capital gain, and that's taxed like ordinary income. Are they really going to hold more than a year to try to minimize your taxes? Probably not. Index funds, they just are trying to go with the flow, and so there is less trading going on with an index fund than there is with a typical actively managed fund. So let's say you want to start saving for retirement, and you want a fund without too many hassles. What's a good category? The first thing you should do is check out and see if through your employer you have a 401k or 403b plan. 401k, we'll talk about this next week, is what you'd have through a for-profit employer, and 403b is basically the exact same thing except through a non-profit employer. Don't ask me why, they have different plans, but these are just tax code designations that they're identified by. But check out and see if you can get in your employer's 401k or 403b plan, because we'll talk more about why, but then you're kind of limited to their options. Your other alternative, if you don't have one of these, and again we'll talk about this next week, would be something like an IRA for retirement. More on that next week. But what type of plan would I like? A target retirement date fund. Now what these do is you pick your target retirement date, and I had my Vanguard fund open. Where did it go? So yeah, you pick your target retirement date. So this would be, what year is this? 2020. And let's say you're planning to retire in about 45 years. This is 2020. And so what you would do is just simply, and this is so you don't have to worry about it. You've got somebody else taking care of it. You don't have to make any decisions. You just put your money in the Target 2065 retirement date fund. And what they do is over time, they will adjust the fund for you based on, it's just for the average investor willing to take on average risk, they'll adjust the fund for you based on how close it is to retirement. So a 2065 target retirement date fund right now, if my internet connection was faster, but right now that fund is about 90% stock, 89% stock, and about 11% bonds and money market stuff. So this fund is mostly stock. So remember, we said younger investors would tend to have more money in stock. This is for a long-term thing, like we're saving for retirement. So Vanguard has almost 90% of the money in stock. So they've got this in the total stock market, US. They've got about 54% in US stocks and about 36% of that in international stocks. So they've got a pretty good exposure to stock outside the US. and 7% in US bonds roughly, and 3% in international bonds. So they've got your money split up in 4 different big pools, well, very big pools, because the total stock market, that fund has about 2,000 stocks. I don't know how many in the international, but I'm sure it's a lot. You've got money invested all across the globe. You're not trying to beat any particular spot. You're just trying to match the overall market there. So that's you, target 2065. And let's say I'm the target, what year is this? So let's say I'm the target, 2025 is a little sooner. Yeah, I'm probably between, so I'm 59. So let's just make me the target 2030. I'm 58. So if I retired at age 67, that'd be roughly 2030. And so there, this fund still 68% stock, 33% bonds. So this has got 40% of the funds in the total stock market, 28%, 27% outs in the international, and then 23% US bonds, about 10% in the international bonds. So again, as you get closer to retirement, you want a little, fair bit less risk. So these bonds, the 31% bonds there, cushion some of the downside that you have from just being 90% stock. So actually these got hit pretty hard as well with the coronavirus. Let me look at performance. There's the, okay, so we'll look at the, oh yeah, here we go. So over the past year, the target 2030 with that 30-some% bonds is down about 6%. The target 2065 over the past year is down about 10%. So that's actually not as, that's from the beginning of the year, and the market hit a high later than that. But so, protection, some, not down quite as much as the you guys' portfolio with more time to go. But again, even though this is down now, if we look at the longer stuff there, the target, this is the target 2065 hasn't been around for 10 years. But anyway, you're taking on more risk, but you've got a higher upside potential because you've got more stock in that portfolio. But even though it looks scary right now, again, you're looking at the long-term view. We look at the long term here. The last 10 years, well, it's about 7% return on the target 2030. Since 2006, it's earned about 6%, which isn't stellar, but considering we just had this major drop, that's kind of pulling all these averages down. And you're looking at a 40-year investment horizon versus a 10-year one. So anyway, but just putting your money in a target retirement fund, what it's going to do is change your allocation over time, handle all this stuff without you having to get involved or losing any sleep over it. So early on, it'll be more stock and focused on capital gains. Later on, it will move towards more generating cash flow and preservation. So nice category here. They'll have different names. Target Retirement Date Fund is a common name for it. A lot of retirement plans, if you do through your employer, this would now be your default option. So if you open this and don't pick where you want the money to go, some of them will put you in a target retirement date fund, but you should make sure you want to know where your money's going. But this is a simple, hey, I don't want to think about it. This is all too complex. It's all scaring me. Just put it in a target retirement date fund. There's different funds have different allocations. None of them are perfect, but put it in there. Think long term and try not to worry about it. So again, it's a simple choice, and this is going to be on the test. So it's a simple choice from life. Well, it sounds simple. Just put it in the target 2065 fund and don't worry about it. 2065 is a ways off. So you're looking at the long term when you make an investment like this. Well, let's pause here and we'll pick up with some bond mutual funds in the next part.